Is mortgage insurance available for apartments? The answer is yes. If you're purchasing real estate, a building or a piece of property that has more than 5 units in it, you can get mortgage insurance for that property with as little as 15% as a down payment. The mortgage can be amortized over 25 years. In some cases you can get it to 40 years, but your premium will increase. The insurance premium is based on the amount that you borrow, and the range of premiums can be anywhere from 1.75% all the way to 4.5% of the mortgage amount. It's important to note, and we get lots of requests like this incidentally that come through emilynow.ca. People say, look, I'm buying a mixed-use building, so there's retail on the main floor, and then there's 2 stories of residential units above. Can I get insurance for that, or can I purchase this property with a little down payment? And the answer is yes, subject to the residential floor area of the property being more than 80%. So in the example where you have a mixed-use building, you have retail on the main floor and maybe 2 floors of residential. As long as when you add up the square footage of the residential units, that it is more than 80% of the square footage of the whole building. Some of the basic criteria is that you have to make sure that for every dollar of debt that there is in terms of a mortgage payment, you've got to have at least $1.10 or $1.15 of net income. You're going to have 25% of the mortgage amount in net worth, with a minimum net worth of $100,000. So if you're going to borrow $1 million because you're going to buy a really nice apartment building and hold it for investment purposes, you're going to have at least $250,000 of net worth in order to meet the basic criteria. As a side note, because we're socially conscious around here, as are many people these days, and believe it or not, so are the insurance companies. If you end up purchasing a multi-family or a multi-unit apartment building or piece of real estate that qualifies under the energy efficiency guidelines, that you might be able to save up to 10% of the premium that you end up paying. So here's some things that you really need to know, and we talk about this quite often with folks that come through emilynow.ca. They're looking for a mortgage on a multi-unit building, and one of the gaps that exists in the marketplace is when somebody sells a property, they usually base the sale price on what the current rental rates are that a building is getting. And so here in Calgary, for example, rents have continued to go up, and there's a very low vacancy rate. So in the last little bit of time here, we've seen rents be very, very strong. So what happens is you get folks that own these apartment buildings, they put them on the market to sell them, but they base the purchase price on what the rent is that is currently being received based on the local market. The challenge becomes that on an appraised basis, when the bank goes to say, okay, well, let's see how much this is worth. We know you're going to pay $2 million for this property, but is it in fact worth $2 million? Well, what they do is they'll take the rent, but they have their own calculation that they use, and that calculation is usually based on sort of a national database of rental rates. They're based on averages. So what that means is if an apartment building is generating maybe $1,000 a unit, the vendor might say, well, no, but I'm getting $1,800 a unit right now, and so my property should be worth more, and that's why I'm selling it to you at this higher price. But the bank comes along and says, well, in order for us to finance the building, we're actually going to value it lower, because if we average out the rents over time, it's not $1,800 a unit, it's closer to $1,000 a unit. So what does that mean to you? Well, if you're buying one of these apartment buildings that has been priced at the high end of the value because of where rental rates are, that you may have to come up with the difference. And so if you're if you're purchasing a property that's $2 million, if the bank comes back and says, we think it's only worth $1.7 million, we'll lend you 85% of $1.7 million, well, you're going to have to come up with an additional $300,000 over what you originally hoped to put down, because the vendor, the person selling that building, they're not going to want to sell it at that lower price. So There's lots of resources on the internet. You can jump on our social media channels and get a download to the CMHC multifamily guide, and so we'll post that after this episode so that you can do it. You can read these things for yourself, but just the big takeaway should be, yep, you can get insurance on apartment buildings or mixed-use properties that have a residential component. You can do it with as little as 15% down. You need to make sure that the price you're paying will check out with the appraised value that's going to be used.